We are again around that time of the week where we bring to you our webinars which are packed full of information and some fun Q&A. At 10 a.m. we have a webinar on rising inflation, how to make your money work harder for you. We have another webinar at 10 a.m. on the iThought PMS ecosystem, which will cover everything that you need to know about us. At 11 a.m. we have a webinar exclusively for all the amazing women out there, a candid conversation-based webinar which will help you chart out your wealth creation journey. If you would like to be a part of our webinars, don't forget to register. You can find the registration links in the description. See you all there. In this video, we will look at the various types of debt mutual funds. Dynamic bond fund. In this, the fund managers actively manage their dynamic bond portfolios in response to interest rate movements and market conditions. Unlike traditional bond funds that typically invest in bonds with a fixed maturity or duration, dynamic bond funds offer greater flexibility to adapt to changing market environments. These funds invest in a diverse mix of government securities, corporate bonds, treasury bills, and other debt instruments, providing a well-rounded investment approach. Next, corporate bond fund is a mutual fund that primarily invests in bonds issued by corporations instead of government entities. These funds aim to provide investors with regular income through interest payments while also offering the potential for capital appreciation. The balance between risk and return depends on the credit worthiness of the issuing corporation, and there is a possibility that the issuer may default on interest or principal payment. Credit risk fund. This is a type of mutual fund that primarily invests in lower rated corporate bonds to achieve higher yields. This fund carries a higher credit risk compared to traditional debt funds, as at least 65% of its assets are allocated to corporate bonds rated AA or below. Investors should be aware that there is an increased risk of default by bond issuers, particularly with these lower rated securities. Next will be banking and PSU fund. This is a debt mutual fund that primarily invests in debt instruments issued by banks, public sector undertakings PSUs, and public financial institutions. These funds are generally considered safer than other debt funds as they invest in entities with strong credit ratings and government. They provide stable returns while maintaining a relatively low credit risk by focusing on high-quality debt instruments. However, investors should be aware of the risk of a decline in bond prices due to rising interest rates. The next category is gilt fund. This is a type of mutual fund that predominantly invests in government securities, which we commonly call G-Secs, issued by the Reserve Bank of India on behalf of the Government of India. These funds are considered some of the safest debt mutual funds because they carry minimal credit risk due to the sovereign backing. Gilt funds provide stable returns with low credit risk by investing in risk-free government securities. However, external factors such as inflation data, geopolitical tensions, or changes in the fiscal policy can lead to short-term volatility in the performance of gilt funds. Next, floater fund. This is a type of debt mutual fund that invests at least 65% of its assets in floating rate instruments. These instruments feature variable interest rates that are periodically adjusted based on current market rates. Floater funds are ideal for investors looking to benefit from rising interest rates while minimizing the effect of rate fluctuations. They come with moderate credit risk, which depends on the quality of the underlying instruments. These are the various types of debt mutual funds that are available. And in the next video, we will look at the various types of hybrid schemes.